In this lecture, I'll describe you what do you mean by financial management, what are the three decisions of the financial management, what are the new decisions which we have included in the financial management. If I explain briefly, then business is anything which is going to satisfy the customer needs. So while satisfying the customer needs, a business owner works with employees, does some operations, and then receives money in lieu of that. It pays money to the employees and it pays money to the operations for the business. So that means business is all about managing the money, and managing money is really important for the business. So this is what is the primarily functional domain of the financial management. So when I say a particular entrepreneur or a businessman, say we have taken an example over here of Mr. Rohan Bajaj that he wants to start a hotel. He'll buy land, he'll construct the kitchen, he will set up the restaurant area, he will set up the rooms and everything. We call it all these as fixed assets in the company. He will designate a name for his company which will eventually become big, and we call this as an intangible assets for a company. So when a company makes decisions related to the creation of the assets and the future course of the business, we call that as an investment decision or capital budgeting decision. We also call it allocation decision because this is the decision related to how the funds will be allocated in the company. Similarly, he may decide from where to get the money. He may use his own money, may get money from the friends and family, may get it from the banks and financial institutions, or maybe from the financial markets like stock markets, bond markets. So each of these categories we can divide in the form of equity or debt, but the proportion with which the businessman or the business decides that from where to get the money is known as the capital structure decision or the financing decision. Okay, so when I say that they may get in the form of equity or they may get in the form of debt, we should understand the basic difference between equity and debt is that equity, when a particular source is investing in the business in the form of equity, so that means they are the primary risk takers, they are the partners of the company, and they will take the profits from the company, and they are called as shareholders. When we say debt, they are providing the amount or the finance for a fixed period of time. They wish to take lesser risk, but in lieu of that, they are saying that we can take the lesser amount of return, but their returns are usually fixed. Okay, so can an owner's money be equity as well as debt? Yes. Owner's money can also be in the form of equity and debt. Many a times the promoters give loan to the company, and this we consider in the part of separate entity, business as a separate entity concept. So business is different from the owner, and owner can also invest in the form of equity, which will be known as promoter's capital, and he also or the promoter can also invest in the form of loan, which we call it as a promoter's loan. Okay, they may take it from friends and family. Obviously you can understand that if they are investing in the form of like as a partner, so it will be equity. If they are investing in the form of loan, so that will be considered as debt. Banks and financial institutions, various forms of financial institutions exist which invest in the form of equity. For instance, private equity, financial venture capitalist firms. Okay, so they all invest in the form of equity. Usually when in the term of banks, the universal banking system which we see, that provide loan to the company, that is known as term loan or debt in the company. Financial markets. When the promoters raise the money from the stock market in the form of equity shares by issuing the shares in the stock market, we call that as equity shares. And when they issue the bonds in the financial market, we call it as a component of debt. Okay, what do each equity holder get? They get the residual amount, because we say that it is a limited liability company. Limited liability company means the promoters have only that much stake in the company to the extent they have invested the money in the company. So their liability is also to that extent only. So what do they get in return? The debt holders get the interest, okay, and the equity owners get the government gets the taxation, and the equity owners get the residual amount, which we call it as dividend, in the form of dividend. Here also, usually we include dividend decision as a separate decision, because we see that the company may decide to share the dividend or may not decide to share the dividend, or there may be decision related to how much dividend to be shared with the equity owners, because business also has investment needs. So many a times dividend decision is considered as a separate decision, but for our purpose we will be taking dividend decision as a part of the financing decision, because this is one form of the finance where the company decide whether to use the internal resource in the form of its own retained earnings, or may use the outsiders resources. Okay. Now, let's see the another decision, which is working capital decision, because when company is working, they may sell the goods on credit or they may buy the goods on the credit. While buying and selling the goods on the credit, and there may be some like company will not be paying the salary, the wages, the rent, the fuel bill immediately. So there will be some dues also. There may be some always lag in the payments. So all this is known as the working capital management. And the objective of the working capital management is always to maintain the liquidity in the company. Now let's summarize. The investment decision is how the company is going to earn the profits in the business. This decides the key area for the company, because the kind of investments and the type of investments company have is going to decide the future course for the company. The objective of the investment decision is always to maximize the returns. Next decision is financing decision, that is how to raise the funds. Generally, there is chicken hen problem, like whether the investment decision come first or financing decision come first. I'll say it is a chicken hen problem, and there is no like precedence of the investment decision or the financing decision. Some may say that the investment decision come first, but even if you do not have a little bit of the seed capital, you cannot decide your investment decision. It remains still at the idea stage. Then comes your working capital decision. The objective of the financing decision is always to minimize the cost of financing, which we formally call as cost of capital. And the working capital decision, the goal is to maintain the liquidity in the company, to maintain the cash position so that the company can pay its liability as and when due. And the dividend decision, though it is a part of the financing decision, but in many of the books and many of the authors treat it separately also. Okay, and the objective here is always a conflict between whether the internal needs are important or the money needs to be shared with the shareholders. So he is again confused that how should the company make the decision as an overall, and further he is thinking about what is the difference between accounting and finance, and you also have two subjects related to this. So let me just briefly tell you the difference between accounting and finance. The accounting is basically a recording, classifying, summarizing, and keeping the historical way of that where we have spent the money, keeping everything accountable. Whereas finance is for the future, it is not, it is for the planning purpose. There is no such legal compulsion that it has to be there, nothing like this. It has to be in this way only. Whereas for the accounting, ICAI, like we see Indian accounting standard, IFRS, US GAAP, all these are the accounting standards which guide how the accounting statements need to be built. Whereas there is nothing like this in finance. It is just a strategic decision, but the decision which the company will make will be reflected in the accounting financial statements of the account, which is balance sheet and income statement. So this is a sample balance sheet of Reliance. These are the fixed assets, working capital, owner's capital, debt, working capital. So now you understand whatsoever decision the company has taken pertaining to finance are reflected in the financial statement. Let's see the statement of profit and loss or income statements. So these are the revenues, from how we will earn the revenue, the way you will make the investment or the company will make investment decision. It will be reflected in the revenue and the cost structure. So interest payment, the way company will make the financing decision will affect how much will be the interest, depreciation on the fixed assets, and then profit after tax, and how the company has made the decision that how many will be the equity owners is going to affect the earnings per shares. Okay, so again he is confused that which one to maximize. We have learned and in the class we have learned in detail that profit is a very vague term. First of all, one must understand, when I say profit, which profits? It is profit before EBITDA, I mean earnings before interest, tax, depreciation and amortization, EBIT, earnings before interest and tax, or PAT, or profit before tax. Moreover, the accounting statements are subject to maneuverability. They are subject to lot many accounting policies, regulations, which make them unsuitable to use as for the decision making purpose. For the decision making, what is important is that we should have the criteria which is ready made, which is easy, which takes into account the future value. So we find everything of that in the wealth maximization. Wealth maximization, we formally define it as a net present value, which is the present value of all the cash inflow minus present value of all the cash outflow. Thus, it measures the present time value of money. It measures everything in terms of cash, which is important for the company. So all the decisions whatsoever the company will make, financial decisions, they should maximize the shareholder wealth. Now, when we talk about the big corporates, there is a separation of owner and the manager. When the owner and manager are the two different groups, what happens that it gives to the age-old problem of principal agent issue. The principal agent issue means the agent is going to manage the money or function on behalf of the principal, which may or may not work in his best interests. So when I say the managers have their own salaries and linked to the performance of the company or the market performance of the company, so what they can do, they may manipulate the company's accounting statements or may manipulate the financial markets market price of the share to look to make the figures look better. Moreover, they may not show each and everything to the owners of the company because owners are diverse, they are at different places, they are not directly participating in the decision making of the company, so they meet only once in a year. So that is why it becomes very difficult for them to control the managers. Due to this, and we have seen so many scandals in the very recent past where the managers acted in their own interest and sacrificed the interest of the owners. This age-old problem had been tried to resolve by the way of corporate governance. We have discussed corporate governance, or we will be discussing more of corporate governance in the class. Basically, corporate governance under the Companies Act 2013 defines the way board needs to be organized, what are the roles and functions of the independent directors. It provides the way that women needs to be inducted into the board as an independent director or as a board member, and remuneration of the CEO or the other needs to be decided by the remuneration committee. There has to be some grievance handling mechanism. So because of all these things, we are trying to bring the transparency into the company. So all the financial decisions now comes the this is a recent innovation. So all the financial decision which a company is making need not only comply to wealth maximization, they need to be transparent also, and that is why we are supposed to follow the corporate governance principles. Okay. So then comes the another challenge which we had been facing over the years is that companies, while making the financial decisions, they forget about the society. They tend to make the decisions which are harmful for the society. We be launching such kind of products, maybe counterfeiting the products and increasing the revenue, maybe trying to reduce the cost, or maybe doing the environmental harm. So that is why there is another concept which has been introduced, and which is corporate social responsibility. Since society is an important stakeholder in the company, so companies cannot ignore the larger interest of the society. The corporate social responsibility also we have discussed in the class, so you can I'll be sharing the report also with you. So what we have learned in this module is, as a first unit, that what are the three decisions of the domain area of the financial management, what are the recent inclusions in the financial management, what is a basic difference between the accounting and the finance, and next we have learned about how to decide that what decisions to be made, that is wealth maximization principle of financial management. Thank you so much.